Silver inventories on Comex have just slipped under a line that should never be crossed quietly. And the way the books look right now, one aggressive delivery month can light this whole structure up. OG John AG here, and this is financial warfare education. Not hopium, not get rich quick, and definitely not sponsored stock pitches. We're going to walk through the Comex vaults, the open interest, the Shanghai premium, London volatility, the yen carry trade, and why silver's volatility is now priced like a bomb with the pin already halfway out. Comex registered silver just dropped under 90 million ounces, around 88 million currently, while total Comex silver inventories sit near 366 million, down roughly a third from where they were just a few months ago. At the same time, open interest in front-month contracts is over 4 times larger than the metal actually sitting in the registered category, the only category available for delivery. That's not a YouTube title. That's a structural mismatch. If even a modest slice of these contract holders decide to stand for delivery instead of rolling, the paper-to-metal imbalance turns into a liquidity event that can reprice silver violently. And this isn't happening in a vacuum. Shanghai is trading silver over $10 above Western spot. London inventories are thin enough that 1,000 tons of net buying now moves price several percent in a single shot. The market is quietly telling you the days of cheap, sleepy silver are over. Segment 1, Comex, the inventory cliff. Let's start with the vaults. Total Comex silver inventories, about 366 million ounces, down from roughly 532 million back in October. That's a drop of almost 31% in just a handful of months, in a market that's supposed to be the backbone of global silver liquidity. But the real story is registered silver. Registered means warrant issued, deliverable metal. That number is now around 88 million ounces, just below the 90 million line that a lot of serious people have been watching as a do not cross casually level. Now put that next to open interest. The open interest in the front contract is more than 400% of the registered metal. For every ounce sitting in the registered pile, there are over 4 ounces promised in paper. If everybody rolled peacefully forever, maybe that's fine. But the moment more players decide, no, I want the bar, not the promise, that's when the system has to either deliver metal it doesn't really have, or pay people to go away at a much higher price. That is what a liquidity event in a physically settled futures market looks like. Not drama, math, segment 2, delivery risk, tomorrow, next month, and beyond. Now look at timing. We've got a delivery date staring at us. The February 2026 futures contract hits its key settlement window tomorrow afternoon. That's when shorts can be forced to deliver and longs can decide whether they stand or roll. Will we get a full-blown squeeze on that exact timestamp? Maybe, maybe not. The point is not to pretend we know the micro-timing. The point is to understand that with each delivery month that passes without a meaningful rebuild in registered stocks, the odds of a future squeeze go up. March is the real problem month. March is always critical for silver deliveries. That's when industrial users, refiners, and players who actually use the metal step up if they're running lean inventories. If too many of them stand for delivery while registered stays stuck in the high 80 million range, the exchange has to juggle. Who gets metal? Who gets cashed out? How far price has to jump to shake loose new supply? That's why I keep saying, stop watching only the daily price and start watching the relationship between open interest and registered metal. A ratio this skewed is not normal. It's a live stress indicator. Segment 3, Shanghai. The $10 premium and $700 tons. Now let's cross the ocean and see what the East is telling us. Shanghai silver is trading at a premium of more than $10 over Western spot prices. Not 10 cents, $10. That is not a rounding error. That is a break between two worlds. Add up inventories across China's main exchanges, SGE and SHFE, and you're looking at roughly 700,000 kilograms of silver sitting in that system. Against that backdrop, a double-digit premium is the market saying, we value silver more than your Western paper benchmarks. Now combine that with what we've already seen. Eastern buyers securing physical at any price. Western traders still trying to treat silver like just another ticker on a screen. A persistent premium between Shanghai and Comex is a red flag. It tells you that if Comex tries to settle a delivery crunch with paper-only solutions, the real physical flows will simply reroute east, where the bids are higher and the contracts actually settle in metal. You want to know where the true price of silver is. Watch where the bars flow, not where the talking heads say the spot price is. Segment 4, Volatility, VXSLV, and the broken vol market. Next, we go to the part of the market that sniffs danger before most humans even see it, volatility. Look at VXSLV, the volatility index for the big silver ETF. Volatility in silver is exploding higher and is now not far from prior panic peaks, even though the silver price itself is still meaningfully lower than during those previous spikes. That is not normal. Normally, vol spikes with price, then cools as price consolidates. Right now, the options market is pricing daily swings north of 6% in either direction, while the spot chart still looks contained to anyone just glancing at a daily candle. And it's not just about Comex options. London's inventory situation means that roughly 1,000 tons of net demand in the LBMA system now drives about a 7% move in price, versus around 2% historically. When the same amount of buying suddenly has 3 times the price impact, you are in a thin, fragile market. Put simply, the volatility market is screaming that something big is coming. If you're only watching price, you're watching the movie on mute. Segment 5. SLV, technicals, and the speculators on the sidelines. Let's talk tape, the ETF, the technicals, and the speculators. Look at SLV over the last 6 months. It's been stair-stepping higher along its 9-day moving average in a classic bullish pattern. Whenever it briefly dipped below that short-term line, it didn't matter much. The real test came when SLV slipped under its 21-day moving average and couldn't recover it immediately. That kind of behavior usually starts to build a downside setup, but this time it held at the 50-day moving average, just barely, and then ripped back up to reclaim the 21-day, closing above it and now wrestling with that line again. If silver can stack a few solid closes above that 21-day with this kind of fundamental stress, the path of least resistance is higher, at least up into the gap area around the equivalent of high 90s on the ETF scale. Now here's the crazy part. The big speculative traders, the non-commercials in the Coty report, still are not fully on board. They've been reluctant to chase or support the upside, and their positioning actually weakened after last summer's parabolic run. Historically, these guys are eventually on the right side of big silver moves. Once they flip and start piling in, the fuel that's been sitting on the floor turns into fire. Right now, they're late. And in a bull phase, late speculators don't produce gentle price action. They produce vertical candles. Segment 6, yen carry trade, Japan. Lights the fuse. Now we bring in a piece almost no silver tourist talks about, the yen. The Japanese yen has been weakening again after comments from Prime Minister Sanai Takaichi, signaling discomfort with aggressive rate hikes and a reluctance to tighten monetary policy. She even called hiking rates a stupid idea back before taking power. And her stance hasn't exactly flipped now that she's in the big chair. Why does that matter for silver? Because a weak yen feeds the yen carry trade, borrowing cheaply in yen to buy higher yielding or higher beta assets elsewhere. Silver has been one of the key beneficiaries of this trade. Overlay SLV against FXY, the yen ETF, and you see the pattern. When the yen weakens, silver rips. When the yen rallies, silver gets slammed. Now Takaichi is lining up new BOJ board nominations that look more dovish than hawkish. More likely to keep rates pinned, less likely to defend the yen aggressively. After her recent comments, the yen pushed toward 156 per dollar, a weak reading that aligns with more fuel for the carry trade. If these nominations confirm a low-rate pro-stimulus stance, Japanese investors will keep looking for hedges against a weakening currency: gold, silver, and other real assets. That is another macro tailwind blowing behind an already tight silver market. You don't have to love macro. You just have to respect what happens when cheap funding meets tight supply. Segment 7, gold-silver ratio, when leverage wakes up. Now let's pull up the old friend, the gold-silver ratio. We're trading in the high 50s now, roughly around 58, smack in the zone where silver's leverage historically kicks in during a metals bull market. Once the ratio breaks below about 60-65 during a true bull phase, silver starts to move 2 to 3 times as fast, in percentage terms, as gold. Any sustained break and hold below roughly 55-58 is the market yelling, silver is about to outperform hard. That's not opinion. That's what the last major cycles have shown. The ratio is not a magic number. It's a pressure gauge. In an environment with Comex registered near 88 million ounces, open interest 4x that, Shanghai trading double-digit premiums, London inventories thin, volatility pricing 6% daily moves. A falling ratio is not just another data point, it's confirmation that silver is the release valve for system stress. Segment 8, how this can play out without hype. So how does this actually break? One path. February delivery passes without a dramatic squeeze, but registered stays low and no fresh metal flows in. March arrives with industrial users stepping up to stand for delivery. Comex has to choose between burning through registered stocks or incentivizing longs to cash settle at a premium. Another path, speculators finally flip bullish. SLV and other vehicles see hard inflows. London's 1,000-ton demand blocks hit the tape, moving price 7% a shot. VXSLV spikes further, and silver starts printing daily candles that would have looked absurd last year. Third path, the yen weakens more as the BOJ stays dovish. The carry trade pushes a new wave of leverage into silver. Macro tourists chase late, amplifying the move. None of these paths require fantasy. They only require what we already see: structural tightness, paper overpromising metal, Eastern premiums, Volatility already elevated before the main price move. Could we get a false start? Absolutely. Silver can drop 10% in this environment just as easily as it can rip 20%. Volatility cuts both ways, and the market will happily shake you off the train before it reaches the next station. Segment 9. Discipline for stackers versus traders. Now the part most videos skip. How to think about this without blowing yourself up. If you're a physical stacker, your job is not to time the exact day of a Comex squeeze. Your job is to accumulate ounces when the system is still willing to trade them for digital fiat at what future you will probably consider stupidly low prices. The structural story, declining inventories, rising volatility, Eastern premiums, macro tailwinds, is the reason to own metal, not to chase every candle. If you're a trader, different game. With volatility this high, stop-loss discipline is not optional, it's survival. Big intraday swings can and will hit both your take profit and your stop in the same week. Keep position sizes reasonable. Respect volatility. 6% daily expected moves means you're not trading a sleepy blue chip stock. Use options carefully. Leverage in a broken vol market can kill you faster than it makes you rich. And if you're short silver here, understand what you are standing in front of: a structurally tight inventory picture, a lopsided Comex ratio, a rising vol regime, a macro backdrop that increasingly favors real assets over promises. Shorting into that may pay off if you nail the timing, but if you're wrong, the market doesn't just punish you, it erases you. Outro. Read the tape, not the headlines. This is financial warfare education, not investment advice. I'm not telling you to go all in on silver, and I'm not telling you to ignore risk. What I'm telling you is this: Comex inventories are shrinking. Registered metal is below 90 million ounces. Paper promises are 4 times bigger than deliverable stock. Shanghai is paying more for the same metal. London is thin. Volatility is broken, in the direction of explosive moves. The yen carry trade is back on. The gold-silver ratio is in the danger zone for silver shorts. You can ignore that, or you can integrate it. Do your own due diligence. Protect your capital. Manage your emotions with the same discipline you bring to reading the data. If you're still here at the end of this, let me know in the comments where you think the real breaking point is for Comex. And drop OG John AG so I know you watched with your brain turned on, not off. OG out.